Apparently, if Tesla's stock reaches explosive heights, it may be worth $40 trillion. What $40 trillion opportunities does Tesla have? It comes from the study Mother of All Capex Cycles by Morgan Stanley. What does this study report's main theme center on? And will the upcoming year show investors how Tesla and the rest of the auto industry are essential to the move away from fossil fuels? Keep an eye out to see if electric cars could significantly alter how the transport sector uses renewable energy. Presuming that all automakers switch to electric vehicles, the next battery technology and the materials used to make it are the finest ways to benefit from the multi-trillion-dollar energy transition's lucrative momentum. Many people believe that soon the entire world will run on batteries. Based on Bloomberg, a record $501.3 billion were invested in the global energy transition in 2020, and a revolution-worthy quantity of money is pouring into new energy. An energy transition can be supported by institutional foundations and endowments with assets worth over $14 trillion. It is referred to as a paradigm shift by Forbes. The fact that legacy manufacturers have a big market focused on internal combustion engine automobiles raises investor concerns about this sizable chunk of money. With this significant investment, legacy automakers are seeking to support both internal combustion engines and electric automobiles. They can only serve one client, and if it's not an electric vehicle, they'll go out of business. Additionally, sustainable energy is becoming much more affordable. Electric cars will soon be on par in price with traditional cars, possibly as early as 2026 or earlier, and energy storage costs are also dropping quickly. Storage is the key to it all. Without sophisticated batteries, which need for the usage of battery metals, none of this is conceivable. When it comes to electric vehicles and renewable energy in general, Tesla currently leads this sector. Utilizing this transition will increase the brand's value and even double or triple it. Morgan Stanley claims that Tesla is overvalued and undervalued at the same time. They think it is pricey as a firm that only makes vehicles, but that as an onshore infrastructure provider for renewable energy, it may be significantly undervalued. They consider Tesla to be the best battery capex investment. According to Morgan Stanley, two significant occurrences will reward energy innovation. Given the current situation, we anticipate that changes in the next 6 months will significantly affect the story surrounding what Tesla accomplishes in the markets it serves, its growth trajectory, and the global strategic implications of the ecosystem on which it is based. A growing number of investors are also starting to recognize the advantages of Tesla's direct-to-consumer business model, which conventional manufacturers are unable to implement because of strict state dealer franchise regulations. Instead, it eliminates the intermediary and lessens political gamesmanship, enabling the brand to effectively serve its clients. In essence, Tesla is free to sell cars whenever and however they like. Legacy manufacturers use outmoded showrooms with outmoded sales techniques, in addition to additional partnerships and inefficient red tape. Morgan Stanley thinks that as globalization advances into a new era marked by growing national security concerns, broader forces are driving the multi-decade trillion-dollar battery capex cycle. Tesla will be able to produce more batteries than anyone else, as Elon Musk has claimed that the company will likely start their own mining operations either by acquiring mining businesses or starting their own from scratch. It's encouraging that Morgan Stanley is considering Tesla's options beyond the automobile industry. Their potential for other sectors, such as energy storage, will be crucial in the future, and Tesla is well positioned to lead. Thanks to a $4 billion agreement to sell 100,000 vehicles to rental car company Hertz, Microsoft, Amazon, and Alphabet will benefit. It's crucial to understand how Elon Musk's business stands out from the competition, though. It is classified as a trash bond to start. Tesla's long-term debt was recently raised to BB+, one rung below investment grade as a result. Sales and profitability are far lower than those of rival companies. This year, Tesla is predicted to generate $6 billion in revenue, placing it around 1/5 behind Apple and 1/10 behind Amazon. The debate over Tesla's value is still going on. Almost all other big automakers together are valued less than Tesla. On where it is right now, analysts aren't all in agreement. Tesla's $1 trillion milestone is just the beginning. In a recent tweet in the bear camp, Daniel Ives of Wedbush Securities stated that Roth Capital Partners' Craig Irwin had stated that Tesla's stock was outrageously expensive at 173 times next year's earnings as a result of multiple countries cutting EV subsidies. Additionally, given the current macroeconomic situation, analysts predict that the market will consolidate, with subpar brands being eliminated with certainty. How is Tesla currently doing? Investors in Tesla have experienced a roller coaster year. Around $1,200 per share was the price of the stock at the start of the year. The automaker's stock price then fell dramatically, reaching lows well below $800. The producer of electric vehicle stock is currently selling for slightly around $1,000. Much of this volatility is a result of how uncertain the company is about its future, especially in the near future. Nobody knows how much the manufacturing standstill brought on by COVID-19 regulations enforced by the government in Shanghai has impacted the company's production rates. Thankfully, Reuters reports that the company will shortly start operating at its factory in China. It would be odd to see a slow ramp-up back to previous production levels, though, considering the demand for third-party supplier participation. On the 20th, when Tesla releases its first quarter numbers, investors will be looking for clarification. How soon does the manufacturer anticipate that its Shanghai plant will start up again after the shutdown is over? Does Tesla have a chance of achieving its full-year vehicle delivery goals? Therefore, investors will be paying close attention to any predictions Tesla makes for full-year vehicle deliveries when the company releases its earnings this week. A 3-week production halt at Tesla's Shanghai plant raises the possibility that the company may need to cut its full-year forecast for vehicle deliveries, although there is still a chance it will stick to the original projection. The company's new facilities in Texas and Germany are at the center of this controversy. Despite management's claim that it could grow by more than 50% without the help of these two plants at the automaker's fourth quarter update, both factories have since come online and could contribute significantly to Tesla's volume growth. Tesla is starting a new phase of growth as a result of the two new factories. A cyber rodeo was held by Elon Musk at Giga, Texas, which will eventually house the company's headquarters. Tesla regularly engages in cyber rodeo, which produces free advertising. The event drew sizable audiences with an estimated 15,000 invitations distributed and more viewers seeking to attend without one. In his presentation, Musk also updated his company's strategy. He forecasted that 2022 would be the year of scaling and that 2023 will usher in a plethora of new goods, such as semi-roadsters and Cybertrucks. The fact that this new facility is the largest factory in the world in terms of volume, according to Tesla, makes it an engineering marvel. Therefore, it is even more amazing that Tesla was able to merge all parts and functions under one roof as opposed to separate buildings like older manufacturers. We think that Tesla's cost leadership in battery/powertrain technology is a crucial competitive advantage that has allowed the company to manufacture electric vehicle models that are far more affordable and offer comparable performance to internal combustion engines than its rivals. What does the future hold for Tesla stock? Future Tesla stock prices will likely be influenced by the speed of the switch from conventional fossil fuel engines to electric automobiles, as well as the company's financial performance. As we have stated, this $40 trillion opportunity is available for the taking with Tesla in the lead. Given its leadership position in EVs, we think Tesla will be well positioned to profit from the long-term switch to EVs. The Model Y's ramp-up, new plants in Austin, Texas, and Berlin, Germany, as well as an eventual rise in Tesla's share of electric vehicles, should all benefit the company's finances. What forecast do you have for Tesla for the upcoming second fiscal quarter? Post a comment below.